When I first approached financial statements like over a decade ago, it was very confusing that there's so many line items. But one of the things you always hear in this industry is
So in simple math, the revenue minus the cost of goods sold gives you the gross profit. So this is how much money they make on an Air Jordan or Dave's special $30 jogging shoe.
it was like a light bulb moment for me when I realized that stock.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to do something kind of fun. We are going to start analyzing an income statement. One of the biggest questions that we get is, where do we start? Most people, when they start investing, don't know where to start. And a lot of you will hear us talk a lot about financial statements and how important they are to read. Well, today, Andrew and I thought we would break down how you should try to read an income statement. And not ironically, but kind of ironically, we're going to do Nike. And the reason why I say ironically is because Andrew is actually wearing a shirt with a Nike logo on it. So those of you who watch us on YouTube, you will see this in action. So let's talk about income statements a little bit, and then maybe we can break one down for everybody.
This content has just gotten really exciting at this point.
Right, right. It's all about the Nike and the swag.
I did buy a stock recently in this industry. Won't say if it was Nike or not. It is top of mind. So when you're going towards an income statement, what are you trying to accomplish? Do you have a sense whenever you approach an income statement that it's like, okay, yeah, I want to try to find out this, or is it approaching it with an open mind? How does it do it for you? And if we were interested in Nike, which I've been interested on and off for a while, what do you do when you come across an income statement like that?
Yeah, that's a great question. I think the first thing, well, the few things that I want to try to take away when I walk into a company that I don't know is I want to see obviously what kind of revenues they have, what kind of revenue growth they have, and I want to find out what kind of profitability the company can generate. It doesn't necessarily have to be specifically each section of the income statement, but certainly I want to know overall, is this company growing revenues, and is it profitable? Are they making money from the things that they sell or do? And if I can answer those questions, that can help me continue down my research. What about you?
Yes to all of those things. I like how you highlighted, are they making money? If I were to go back inside a time machine and think about when I first approached financial statements like over a decade ago, it was very confusing that there's so many line items. But one of the things you always hear in this industry is the bottom line.
Right.
What's the bottom line? And so I think it's a great place to start because it answers the question you just asked. Are they making money or not? So for those of you good boys and girls following along at home with your 10Ks pulled up, the net income for Nike is actually bolded in their income statement. So they make it really nice and easy. It's not quite the very bottom line of the income statement, but it's it's bottom enough where you can tell that all the numbers are flowing down to make this final net income number. And yeah, that's pretty straightforward. That is the net income. That's the bottom line. That is how much profit the parent company Nike has made for the year 2024, 2023, 2022. And it's a great place to look. And I'm looking at their income, their net income right now. And since 2022, it's flat. So not even flat, a little bit slightly down. Dipped in 23 and then came up a little bit in 24, but not quite recovered to where it was in 22. So it's like, okay, business has not grown over the last 2 years. That can lend you to ask the question, why is that? And it's a good place to start.
It definitely is. So once you kind of figure out, if you're looking at the net income, where would you go next? What would be something okay, I understand they're making money. Where do I go now?
Yeah. And I feel like you mentioned this already, but my question is, if they're not making as much as they are before, what about the top line? What is the revenue they're generating? Is that also down, or has that been going up? Because if a company's revenues has been going up, but their profits are going down, that could be some things that maybe aren't too concerning necessarily. Maybe costs got out of control. Maybe inflation has hit the company. Maybe they're investing in people and hiring a bunch of labor. Those are all things where, okay, maybe the business itself is growing, even though the profits for those years are not growing.
Mhm.
But then if you see revenue decline and net income decline, to me, that's potentially more troubling.
Mhm.
That tells me maybe the company is slashing prices. And so they used to sell shoes at $50. Now they have to sell them at 45. Or maybe there are less people are buying less shoes. Or maybe more people are buying the $100 shoes and less are buying the $200 shoes. All of those things could be problematic because now we're talking about starting at the top and that's declining. It's
Mhm.
very hard to run uphill when your revenues are not going in the right direction.
Right. Yeah, for sure. For sure. And I think all those things are really good things to make questions about and
Mhm.
then return back to look at what management is saying in the MDA section of the 10K to try to help suss out those clues. Try to put your Sherlock Holmes hat on and go to those sections and go, okay, I see revenue is down. I see net income is down. What are they saying about the revenue? Where is it going? Why, because generally they'll give you some clues sometimes uh, about what exactly is going on with the company and all those things that Andrew asked. Why are the revenues down? Are they selling less shoes? Are they having pricing problems? Are they selling less expensive shoes? Are they selling more of the Air Jordans than the Dave Nike jogging specials for $30? So all those things have a bearing on not only the revenue but also the profitability of the business. And so a really good practice is to write those questions down and then go back to the MD&A or the management discussion and analysis section in every 10K. They will have what they are anticipating or telling investors what is going on with those particular things. Most of the time, they will give you the deets, if you will, on why this is happening. Sometimes they won't, sometimes they will, but most of the time they will. And so you can try to start to put the clues together to figure out, okay, why is Nike's revenue down? What's causing this? What does management think is causing this? Because then the next logical question would be, okay, they see that revenues have fallen over the last 2 or 3 years. What are they going to do to try to turn that around? Or what are their plans? You connect the financials and what management is saying into what they're telling you they're going to do. And that's how you can, air quotes, start to hold the management together. And this is also a part of where taking notes can be super helpful because we all think that we're going to remember everything. But I'm here to tell you, as a 58-year-old guy, it's not happening. I hate to burst the bubble for people, but we won't remember. And so by making those questions, writing them down, typing them out, whatever you need to do to notate those questions and those answers for yourself, the better you're going to be in the long run.
Totally. The MD&A thing, that's super huge. If
Mhm.
you're brand new to this and you go in there and you don't find that kind of disclosure,
Mhm.
don't be discouraged. The tagline around this household lately has been every baby is different. Every company's every company is different too. In the
Yes.
case of Nike, though, you are in luck because there's lots of great commentary about what's going on with the
Mhm.
revenues. So they even break it down ASP or average selling price. They break it down between geography.
Mhm.
North America, here's what's happening in China. Here's what's happening with direct versus wholesale.
Mhm.
Nike is, at least from kind of just taking a scan through bird's eye view, if you will, of their MD&A, they're definitely disclosing all of that. And to me, that does help answer a lot of the questions that you mentioned. The next thing I guess I would ask is once you've gone through that process, if you're stuck or whatever, what's the next thing you want to look at?
The next thing I would look at would be, if I'm moving down the income statement, would be to look at the gross profit.
Mm,
And this is very related to the revenues. And this will give you a direct insight into how profitable is the thing that they sell. So in this case, it's mostly shoes. They also do other things, of course, but the primary thing is shoes. And so if you want to think about that, the gross profit is the cost of goods to produce the shoes, plus the warehousing, maybe the deliveries, the employees that build the shoes, maybe the employees that design the shoes. That can be that I'm not 100% crystal clear on, but those things are all part of the cost of the goods that they sell. In simple math, the revenue minus the cost of goods sold gives you gross profit. So this is how much money they make on an Air Jordan or Dave's special $30 jogging shoes. And some companies will give you a lot more insight. Like it sounds like Nike gives you a lot more insight. Not every company is going to give you all that. So you may have more clear understanding of what it costs the company to make a shoe and how much money can they make from it. And that's very important.
So let me ask, what kind of costs are not included in a gross profit, cost of goods sold?
Usually things depending on the company, but majority of the time things like sales and marketing are not included in there. Things like R&D or research and development are not included in there, and there may be depreciation and amortization are also generally not included in there. And sometimes they may sneak immaterial amounts into those things, but by and large those are three or four of the costs or expenses that you're not going to see in the cost of goods sold.
Yeah, which helps you break down sometimes.
Sometimes.
Is a company reinvesting for growth or investing heavily in marketing? And that tells you a different story than somebody who's like not making barely anything on their shoes, on the
Yeah.
shoes themselves.
Right. Right. And Nike does a pretty good job of making profit from the shoes that they make and sell. Sometimes different companies, if you see that their gross margins are really narrow, some businesses like a Costco, for example, because of the nature of their business, they have very small gross margins. But if you're looking at, let's say you're taking a tech company and you see competitors are generating 60, 70, 80% gross margins, which is the ratio of comparing the gross profit to the revenues. If you see companies that are generating really high ones and then the company you're looking at is like at 22% or something like that, that could be a cause for concern. It could be a myriad of things, but it's definitely something that if you see that's out of the norm for the industry, that's a question you want to answer, like why is this so much lower than everybody else in the industry?
And something Nike does as well is in their notes to the financials. So you would scroll past the MD&A, scroll past the financial statements. In the footnotes or notes to the financials, they have the accounting. They talk about what they're doing for the accounting, how they're defining things. Cost of sales is in there. So you can go and double check and make sure. And again, every company is different, but generally when I've had a question of like, how is a company maybe defining this or that, usually there's good disclosure in that footnote. So
Mm-hmm.
helpful if you're like on top of this and you're starting to learn it, that's a great
Mm-hmm.
place to also check that your thesis is correct.
Yes. Yes. Perfect. All right. So we moved past the gross profit, gross margin, revenue section. Where do we end up next?
So we are at the operating income. Everything that you mentioned that's not in gross profit is going to be an operating profit. And I don't know why, for me, it's easier to think the way I've learned it and the way I guess have memory banked it is not so much what's included in each of these, but what's not included.
Mm-hmm.
So operating income's EBIT or interest, earnings before interest and taxes. So if we think about a company has the operations, maybe they have some stores and they sell the shoes, and maybe they have a website, they sell the shoes. Those are all operations.
Mm-hmm.
The company also has the stuff that nobody wants to talk about. So
Mm-hmm.
things like taxes or things like the interest that you're paying on your debt. Those are big picture, big parent company things.
Mm-hmm.
Maybe it's helpful to think of it like Nike owns Converse, right? So
Mm-hmm.
if they chose to have two operating segments, maybe they have Nike in one segment and Converse in the other, those results are going to be different. But at the end of the day, when it comes time to file taxes and give Uncle Sam what he wants, they're going to combine the Nike and the Converse. And then that one big number is what you add on to get to that profit, that net income, that bottom line. The equity holders, the shareholders, the people who have part ownership of the business, that's their net income, their bottom line. So
Mm-hmm.
That's how I like to think of operating income, in that it's the operations, but it's not parent company level things like
Mhm.
interest and taxes.
Right.
How would you define operating income? Or I guess maybe define it the right way, please.
I don't know if there's a right way or wrong way, but the way I think about it is it's the it's all the costs associated with operating the business to produce the thing that they sell. For example, Nike has to they have to do some sort of research to figure out what kinds of great new shoes they can sell to people that are exciting for people. Then they also have to have a management, or they have to have an office staff to manage those costs as well as the marketing and sales. So you have all these different things that are necessary for Nike to sell their shoes. And the way it always made sense to me was I take the gross profit and then I subtract the all the operation expenses, and that's what I have left from operations. And that's, to me, that is just as important as the gross profit, because it tells me, okay, this is how well management manages what they're making and selling, whether it's a online business or whether it's something more physical like a Nike. How management controls their costs to be able to make profits is important to me. And so that's, I probably spend a lot of time thinking about operating income as part of my analysis of a company.
As do I. I prefer to have a company that is either the top dog in operating margins in their area or at least a leader. And
Mm-hmm.
the exceptions to the rule being if this is like an ultra high growth stock, or maybe the stock's growing twice as much as their competitors, then maybe you sacrifice some margin.
Mm-hmm.
But it makes sense why you're sacrificing margin compared to everybody else, because they're reinvesting in growth.
Right. Yeah, for sure. I think one thing I do want to touch on briefly, as we're looking through these different sections, if you, depending on, Andrew mentioned kind of like a young growth company, companies at different stages of their life cycle will have different relative or industry kind of margins. So if you're looking at a younger growth company, you may see it won't be unusual to look at a company that has gross profit margins positive and operating income margins as negative, and net income, as we get to the bottom, negative as well. That's not unusual. But if you're looking at a company like Nike, who is established, you could say mature, and has been around for a long time, if you see something like a gross profit margin as negative, they're losing money on selling shoes, that's really bad. That's really, really, really bad. You don't ever want, if you ever see that, that's really bad. Just kind of in general, gross margin or gross profit being less than what they sell, that's never ever a good thing. If you see those kinds of things, just be aware. And doesn't mean you should stop your analysis. I, by all means, keep learning about the company as much as you can, but I would caution you, if you're going to buy a company that's got negative gross margins, buyer beware, is I guess
Yeah.
all I'm going to say. Buyer
Yeah.
beware. Moving on to the next section, which is, I guess you could say, earnings before taxes. This is not a real common one area, but it was Warren Buffett's favorite section for what it's worth. But there's some interesting little tidbits in this kind of area. So you want to take a stab at covering those?
Please educate me on the buff dog. I did not realize that that was
Yeah,
a
he loves to compare earnings before taxes so that he can remove the impact of taxes on analyzing a business.
okay.
So he likes to include the whole interest expense thing,
Mhm.
because that has a bearing on how much debt the company has. And so he likes to compare, to
Mm,
him, using
yeah.
EBT is apples to apples as opposed to the other sections. So that's what I took away from that.
And if you're the naysayer who says, well, how can you ignore taxes? You can be a naysayer. You can also be wrong. The the tax situation can be so up and down from
Aries.
year to year,
Mhm,
because there are deferred tax assets and there are deferred tax liabilities, and when you have international taxes being thrown in the mix, and then tax wholesale widespread tax sweeping changes for all
mhm,
corporations, yeah, it's just messy, and so you will see the tax expense go up or down kind of crazy
Hmm.
depending on what's going on. And you see it even more in the growthier companies, particularly if they've had that track record of negative earnings, like you
Hmm.
mentioned, which can be a tax carry forward where they can write off in future profits. But again, depends on what state you earn the income in, or if it's in US or international. So lots of factors, but I do like that. Does it surprise you? I like an approach by the buff dog.
No, it does not surprise me in the slightest. In the slightest. So this is far from a technical term, but I always kind of think of this section as the gobbledygook section because you have things like interest expense, you have income from investments and all this other fun stuff, and then you have the whole income tax expense which you just went over. So there's all kinds of, I like to say, gobbledygook things that don't really have a whole lot of bearing on the operations of the business, and so it's not my favorite section of the income statement, but it is important to look at and understand.
Yes.
For sure. I mean, to me, probably the most important one is interest expense, just because we just did this great video on a company you should avoid at all costs,
Yeah.
talking about interest expense and the impact that it can have on
Yes.
companies. And so that is something very important to pay attention to. The other thing I would probably throw out there is the other income. Sometimes that's positive, sometimes that's negative, and really what that line is can be telling you is if companies have investments in other businesses. And I guess the textbook example is Amazon. Amazon owns, they own part of Rivian, and so Rivian's stock performance is very up and down, and so that impacts, because of the way accounting works, it impacts Amazon's air quote earnings of the business, because if it's hugely negative, then that detracts from Amazon's operational performance. And so it's something to keep in mind when you're looking at companies and you see, why is there, Berkshire is another great example. You look at Berkshire Hathaway's income statement, and some years it's amazing, sometimes it's very anemic, and some years it's hugely negative. And it's not because the company is losing money, it's because of how all their investments are treated. And that's a line item on the income statement, which can be very confusing.
Totally. I work really hard to find the best insights I can every single month at Value Spotlight. To see a sample of my previous work, go to stockwriteup.com. The next big piece, which you would argue would be the last big piece, but a
Mhm.
very important piece, earnings per share.
Mhm.
What's the deal here? What are you looking at here?
Well, this is an interesting place, right? You want to see the net income number, you want to see that growing, but then you also want to see the earnings per share growing. And sometimes it can happen for both reasons, for two reasons at the same time, which are great things. Earnings per share is taking the net income or the earnings or the bottom line of the income statement and dividing it by the shares outstanding that the company has out in the market. And so the higher that number is, generally the better. But that number, manipulated is not the right word, but that number can be adjusted, if you will, several ways. Number one, obviously, if the net income is going up, if you have 100 shares and you have $200 in net income and it goes to 300 and you still have the same amount of shares outstanding, then you're earning $3 per share as opposed to $2 a share. And that's awesome. But the other way that this can kind of be a double bonus is if they're growing earnings, the bottom line, the dollar amount. So it's going from 200 to 300, but you're reducing your share count from 100 to 50, just to make it easy math. So now you went from $2 a share to $4, or I guess $6 a share. And so that is where you can really get some serious growth happening as an investor, because Wall Street loves it when earnings go up. And if you look at a chart of stock market returns, it very closely correlates to earnings per share or earnings growing as well. So they correlate very nicely. And so that when you see that kind of thing happen, and that's something you really want to applaud and want to see.
Well, do you know it was like a light bulb moment for me
Mm.
when I realized that stock prices are per share,
Mm,
like the actual number, the business, the net income profit, the revenue
mm,
profit. None of that. None of that. Yeah, I mean, yeah, it does say something about Nike, how big Nike is,
mhm,
but I'm not buying, even though in theory you're buying Nike, what I'm actually buying is a share of Nike,
mhm.
which is a per share number, which when I look up and I Google Nike ticker, it says $150 per share, whatever the number is per share. So that's why earnings per share matters and
Yes.
not just net income.
Yep. Yep.
And if I wish I could have slapped myself in the face 11 years ago, 12 years ago, whenever it was, and been like, dummy, like this is why it matters. Stop looking at the net income so much.
I was right there with you. I literally saw that chart, I don't know, 6, 7 years ago, 8 years ago, and I saw this chart and they were talking about the returns that people would earn versus the earnings per share growing and it being correlated. And I was like, whoa, okay, like duh, and I do remember looking at a company, I think it was on Guru Focus one time, and I saw that their net income was flat, but their earnings per share was growing because they were buying back shares. And in my idiocy, if you will, was like, oh, that's not that great. But in hindsight, yeah, actually it's pretty good because that's how they're returning capital to investors, is by reducing the share count. So even though they maybe aren't growing earnings, the dollar amount or the net income amount, that gross number by a lot, they're still returning money to me by buying back shares. So that was kind of a duh revelation for me too.
Can we humor everybody with an example of times where that's the opposite case? Maybe the business is getting bigger, but they're diluting so much that your slice of that pie is getting smaller. I mean, that's an unfair thing for me to ask because we don't even look at these type of companies anyways.
No, not
But
really.
there are a ton of companies that just dilute because they're giving away
Mhm,
all the equity to employees, which is great for
mhm.
them, but for shareholders
Not
might
so much.
not
Yeah,
be the best.
not so much.
Do you remember the company that who was it? Jeff and Jason. They said like a 95% drawdown from diluting like a reverse stock split, one for 20 or something.
No, I don't remember now.
Okay.
I don't remember. I know my ex years ago owned Citibank, and they did a 12-for-1 reverse split.
That's all right.
So
Yeah,
I
that's a good
remember,
example.
yeah, I remember my ex-wife owned Citi, and this was a while ago, and they did a reverse 12-for-1 split.
Okay. So I love that example actually. That's perfect because Citibank, I mean, we could probably, I don't know. I've never invested in them and it's never caught my eye, I'll say. Um, I don't think they shrunk that much from a business perspective. Like, always have kind of been a big bank, still are a big bank. But
Mm-hmm,
to your point about that reverse stock split, in 2007, they were around $500 a share.
mm-hmm,
And I'm assuming this is after the stock split,
mm-hmm.
down to like $30 a share.
Yep, that was it.
500 to 30.
Yep, that was it.
That's what you get if a business maybe stays the same size or gets bigger, but they dilute shareholders. That's what
Mm-hmm.
you get, is you get
Yeah,
this crazy cratering in the stock price. It doesn't happen every day, but you would be surprised how many aggressive
does.
dilutors that effectively is happening. Not at such an extreme, but is effectively happening.
Mm-hmm. Yeah, and I can say with certainty that that certainly soured her on investing in the stock market. I had to work
Yeah,
really hard to get her to try to put more money in the market, because that was quite shocking.
yeah, yeah. Beware. They're still only not even at $80 a share. So
Yeah,
fast forward, what is it? 16 years, 17 years
yeah,
later, and they're
still,
still way under 500 a share.
yeah,
That pie has been sliced.
yeah,
That pie has been sliced.
yeah,
You're getting a sliver now.
right. So I guess bottom line, how would you kind of wrap up our discussion of income statements? Maybe why are they important, and how can they take what we talked to them today and start to put this to use?
If you're a long-term investor like Dave and I, you like to hold great businesses over the long term. The important part of having a great business is that it is growing over the long term. And then our ownership is also we're getting that accrued to earnings per share. And so the income statement can be a great place, a great starting place to look for that. There are still other things that need to happen until what happens in the income statement turns into stock returns, but it's definitely the meat. But if we have meat and potatoes, it's definitely that meat, and it does drive a lot of what happens for a business,
Mhm.
kind of like 80/20 principle. So I think operating income and operating margin are really great metrics. But even some of the simple ones, like where's the top line going and where's the bottom line going, those can be very, very helpful too.
Yep.
And don't take those too lightly.
Mm-mm. Nope. I agree 100%. Those are fantastic places to start. And if you don't know where to start, I would at the very least start with those four numbers. The revenue, where is it going? Net income, where is it going? Operating income, where is it going? And the operating margin. And you'll be well on your way to starting to understand businesses and have a good sense of where you could start investing.
Yes. Perfect. That's going to wrap up our show for today. We hope you found it helpful and educational. You can reach out with your feedback or questions newsletter at einvestingforbeginners.com. And if you want more of our help with digging into income statements, looking for great stocks, finding community, go check out Value Spotlight. That's going to do it. Connect, learn, and grow with Value Spotlight. Peace.